Hi there. My name is Shamal. I'm the owner of Asnani CPA, and I wanted to do a presentation specifically on corporations that are operating out of California, but they formed their corporation in Delaware. And what I wanted to talk about was kind of what that two-state compliance requirement looks like. So hopefully this is helpful, and yeah, we'll just get right into it. So the 30-second kind of version, the TLDR on all this is basically a Delaware entity operated from California does have a two-state compliance footprint. So you do have obligations in both the state of California and the state of Delaware. California is a state where they tax income where it's earned, not necessarily where the company has been incorporated. So just because you formed the corporation in Delaware doesn't mean you don't have California taxes if you are operating out of California. You will owe California franchise tax on top of the Delaware annual fees. It's not one or the other, it will be both of them. So it's really important that you get everything right from the start. Make sure your entity is set up correctly, make sure your books are set up correctly, make sure you have payroll done right, make sure you're managing a cap table appropriately, and understand the multi-state filings that you have to do. It's a lot cheaper to do this right from the start versus having to go back and fix it later on. We'll keep it very practical on this presentation. I won't get into too much of the nitty gritty, but I want you guys to just have like a general overview of what you guys need to be covered on. So, quick disclaimer, of course, this is general information. It's not tax or legal advice for your specific situation. I am a CPA. If you're watching this, I might be your CPA, but again, treat this as general advice. Talk to your CPA, talk to your attorney before you make any moves here, of course. So, quick roadmap on what we're going to cover here. Number one, why the state of Delaware? It's the default home basically for venture backed companies. So, we'll talk about how to do that and how to form one. Two, the two state reality of what you're dealing with. Three, just understanding what your financial infrastructure should look like. And four, kind of understanding things such as equity and the taxes based off the entity of choice. We'll talk a little bit also about things like safe agreements and also why I don't recommend S corporations ever for these types of businesses. So first, let's get into why Delaware even. So when it comes to the state of Delaware and why it's really popular, it is definitely kind of a legacy thing where, that's just kind of the way it's always been done. And because it's always been done that way, we still kind of do it that way. You talk to some business attorneys and they might actually recommend a different state depending on your circumstance. But it's very common to just kind of see the state of Delaware just based off history. This has to do with the Court of Chancery. It's a business only court with deep case law, and investors and their attorneys understand the case law here and they trust it. They have their templates ready, they kind of know how to operate that system. The corporate law there is very predictable and it's very board friendly. And you get flexibility on different types of share classes. So it's exactly kind of what investors are looking for before they basically send you over money. It's important to note that if you don't have any plans to raise venture money, it's probably easier to just not deal with the whole Delaware aspect of things and just form the business in California instead. The steps involved in forming a Delaware corporation, specifically a C corporation, is you would file a certificate of incorporation with the Delaware Division of Corporations. You're going to appoint a registered agent located in Delaware because you're in California, so you do need some type of registered agent that's located out there. You need to adopt some bylaws, and you actually do have to hold a board meeting. You want to issue founder stock, and you also want to make sure you just get your EIN from the IRS. EINs are very important. They're basically like the social security number for a business. Sometimes they're referred to as a tax ID number. Sometimes it's called a FEIN, which is like your federal EIN or federal employment identification number. All interchangeable terms, all refers to the same thing, but you do want to make sure that you get that from the IRS. It's a pretty simple thing to get. If you do it yourself, you can go on the IRS website, probably get it in like 5 to 10 minutes. If you have a third party service forming the business for you, they're probably just going to cover you for that. The 83B election, you might want to consider filing an 83B election within 30 days of receiving stock that is subject to vesting. This allows for very favorable tax treatment, especially if founder shares vest over time. I'm probably going to save the details on the 83B election for a future presentation, but just understand that it can make a really big difference on taxable income if your shares are vesting over X amount of years versus you receiving your shares all once you form the business. It's pretty common that investors don't want you to just have, 100% of the shares when they decide to invest in your business, regardless if they're investing through equity or through maybe some type of a loan. So you definitely want to, educate yourself a little bit on the 83B election. But it does, depend on your long-term plans and kind of how you want those shares to vest. So let's get into the two-state reality of what it looks like to have a corporation that is formed in Delaware, but you're actually operating out of California. So do Delaware corporations pay California taxes, assuming that, the owners and the investors, or sorry, just the owners and the founders are based out of California? Quick answer, yes. People sometimes will hear Delaware and assume that there's a tax haven, which is not actually true. If you're operating in California, you basically do have two states that you have to, comply with. So Delaware does not tax out-of-state income, and they don't have sales tax, but that's not where the work is actually happening, right? You just formed your business in Delaware because of, the investor preferences and kind of the legal preferences. California specifically taxes income based off where the business operates from. So just because you formed a business in Delaware doesn't mean you escape California taxes. If your office is here in California, even if that's a home-based office, that's where the work is being performed. California's going to want to collect their money. So essentially what you've done is if you added an extra state, you didn't subtract one. So keep in mind, California is going to tax you based off, where the income is sourced from, which is going to be California, assuming that your team is here, your office is here and your customers are here. There's nuances if you deal with a very remote team, like maybe you as the founder, operate in California, but maybe you have some employees or contractors in different states. That could actually add maybe multiple states on top of California and Delaware to your compliance. However, generally speaking, if the founders are based out of California and that is the ultimate place where the work is being performed at, even though you have maybe, other workers in different areas, even international, it's probably going to look like it's sourced from California still. Delaware has what's called an annual franchise tax, and that's kind of for the privilege of being incorporated there. So keep in mind, you have two state compliances, two state taxes to think about at minimum, which is going to be California and Delaware. After you have formed your corporation in Delaware, you need to also register in California as a foreign corporation. That means you would file what's called a statement and designation by foreign corporation with the California Secretary of State. You would also appoint a registered agent here in California. If you're in California, that registered agent could be yourself, or you might decide to still have a third party do that for you. Just depends kind of on your preferences. You also need to file a statement of information with California, and you are subject to the minimum franchise tax in California, which is usually going to be a minimum $800 per year. Something important to note here is that the statement of information in California and the minimum franchise tax are two separate pieces of work going on here. The statement of information is filed with the Secretary of State, and that is technically not part of your tax return. That is a separate report that you do with the Secretary of State. The minimum franchise tax for California is paid to the California Franchise Tax Board, and that is generally done with your tax return filings. In Delaware, it is separate, in Delaware, it is different because in Delaware, your annual franchise tax kind of functions as your statement of information as well too. So just understand that in Delaware, it's kind of a one piece or a one-step piece of work, where in California, it's a two-step piece of work. So skipping this in California, it's a really costly mistake. I have dealt with situations where people did not realize that they had to file these California taxes and they were only doing the Delaware compliance. And then years down the line, they had to pay, multiples of these minimum $800 taxes for all those years that they've missed, plus late filing fees and just more headaches basically with both the Secretary of State and the Franchise Tax Board. So get it right from the start, definitely. So let's now jump into financial infrastructure, talk about some banking, talk about bookkeeping, payroll, and some statements that go along with that. So bank accounts, please open up a dedicated business account for your business as soon as you have that EIN. You don't want to commingle personal funds and business funds. It weakens your liability protection, and it makes bookkeeping and taxes just really. I understand definitely when you that first year you form the business, hey, expenses are going to happen on the personal credit card, probably, right? Maybe you have to pay the attorneys or whatever to even form the corporation. That's common and that's completely understandable. But as soon as you get that EIN and as fast as you possibly can, get a separate bank account and migrate those expenses over to the actual corporate entity as fast as possible. You don't want to make a habit of using your personal money to have expenses that are for business. Many founders do like these fintech banks. So Mercury and Ramp are pretty common, popular ones. I'm a pretty big fan of both Mercury and Ramp. Just you get a lot more features that kind of help out. They even, I think, have like little mini accounting ledgers now on there too. So doesn't mean you shouldn't have a separate bookkeeping software, but it kind of is like a good way to have like surface level bookkeeping. Me as an accountant, whenever I have access to someone's account like that, and they've kind of gone and added some categories there, it does help me out a little bit when I'm trying to do their bookkeeping, just because I get to see, okay, how does the owner or whoever's working on the business books, how do they think about these transactions? So definitely recommend get a good bank. That being said, your standard banks would be fine as well too. The most important thing is that you just have a separate bank account for the business. There's a model out there called Profit First. It's there's a whole book on it. There's a bunch of material on it. I won't go deep into how it all works, but essentially the idea is you have separate bank accounts for separate functions of the business. So you might have like an income account, you might have an operating account for your expenses, and then you might have like a profit account. You can even have like a tax account. And it just allows you to kind of like make these automatic transfers of money on some type of periodic basis. It could be monthly, it could be quarterly, so that you can kind of budget for different. So once you're running a profit, maybe consider having a separate account for taxes. I've even seen people get a little creative there, where they get like some type of a treasury account, just so they can earn some interest on money that's just not being used right now, just so they can park it somewhere. So just some food for thought. It's not a strong recommendation, but something to maybe look into. I'm a big fan of bookkeeping software. Surprise, surprise, I'm an accountant, so obviously I'm gonna have a bias, and I get it. Like nowadays, especially with AI, you can build a bunch of different things, on spreadsheets. But that being said, spreadsheets, they don't scale, they don't hold up to investor or auditor scrutiny. So I think it's important to still have a bookkeeping software. QuickBooks Online and Wave are kind of my go-tos. They enforce what's called double entry accounting and support GAAP reporting, which is generally accepted accounting principles here in the United States. And it allows you to produce financial statements pretty quickly when you do your bookkeeping on there, so that you can present it to anybody. It signals that the company is ran seriously. Just imagine, right, sending, somebody like an Excel report for your finances versus sending them like an actual financial statement. Like it does, those cosmetics do matter. I think this is really important too, right? When you're trying to raise, funds through some type of round, it just shows that you're doing your due diligence. Payrolls. So when you pay yourself or anybody else, you have now become an employer with payroll obligations. Assuming you're paying yourself and, again, you're in California, you do have to register with the EDD for state payroll taxes. It's important to understand this because California has many different bodies that you have to deal with for compliance. On the legal and, just general legal compliance side, I would say you're dealing with the California Secretary of State. That's kind of who you register your business with and who you do your statement of information with. On the income tax side, you're dealing with the Franchise Tax Board. So that's, for filing your state tax returns with California. But on the payroll tax side, you're dealing with California EDD, and there's a separate registration that you have to do for that, meaning there's a separate account number you will have for that as well too. So if you're working with a payroll software, kind of using like a full service feature with them, they may do the registrations for you, but just understand you do have another tax ID number that's, registered because you're an employer here. You want to make sure that when you're paying yourself, again, you would be considered an employee. So you would be on W-2. This is assuming, just you're taking your regular compensation. What you don't want to do is informal owner draws. This is not an LLC, so you don't want to do something like that. That can look like a dividend in the corporate world. There are some nuances like, hey, what if I sent a business loan to the company on my personal behalf, and now I just want to withdraw that business loan? Definitely talk to your CPA about that, because there might be some interest considerations to make sure that everything looks fair and reasonable with that loan. And that might not be something subject to W-2. But in general, your overall compensation should be coming through W-2. And you should only be taking something that looks like an owner's draw when you're actually intending to pay dividends from profits earned from that corporation. Some of the payroll providers I recommend are Gusto, Rippling, ADP. There's a bunch of other ones out there as well too. Maybe you might need something like a PEO service just because you might have international employees. So something like JustWorks could be a good one for that as well. But the most important thing about having a payroll software on hand is that they are doing the payroll tax filings for you. You really don't want to do that yourself manually. It is just a very burdensome task to do. And honestly, I wouldn't even recommend having a CPA do that for you as well, unless there's some kind of, back end compliance that's just really complicated. They're really mundane reports to prepare, but they're not necessarily difficult. So in my opinion, and I'm saying this as a CPA, I just think that it's not worth paying a CPA to do the payroll tax filings for you. It's a lot more cost effective to have a payroll tax software do that for you. So the financial statements that you would need, there's first is the balance sheet. It basically shows what you own, what you owe at any certain point of time. So it's your assets, it's your liabilities, and then the difference between the two numbers is how much equity is in the business. Next is the income statement, also known as the profit and loss, the P&L. It's how much you made, how much you spent, what's left over as profit. Then there's your cash flow statement. It basically shows you how money actually moved, because sometimes the profit and loss statement isn't the best representation of what your cash is actually doing, especially if you have a bunch of liabilities on the book and you're paying off, maybe a bunch of loans, or maybe you're purchasing a bunch of assets. The cash flow statement kind of reconciles what's going on between your actual net profit and your actual bank statement. I recommend doing this at least on a monthly basis, or at bare minimum a quarterly basis. Just stay on top of it. It's such a pain to have to go back and do a whole year, just because maybe you have to file your taxes, or maybe you have to present this to an investor. Being on top of it makes everyone's life a lot easier. Also, I recommend from the beginning, set your books up to be on accrual basis, not cash basis. Usually when I'm working with LLCs and S corporations, especially if it's kind of like a small, or let's say a family-owned business, or just more of a solopreneur business, or even something where it's like, hey, it's just not intended for, an eventual acquisition, then I'd like cash basis a little more. It tends to just reflect what's really going on. However, I should revert that. When I say cash basis reflects what's really going on, what I mean is that it makes your financial statements reflect more of what's actually happening within the bank statements. However, accrual basis makes a lot more sense for a company that has, intention to be acquired, or to, have more investors on hand, because things like revenue recognition and expense recognition is really important. So a very easy example of this is, maybe you're in a SaaS business and you're selling software subscriptions, and you're selling like annual software subscriptions. If you're doing those annual software subscriptions in December, technically all that revenue is not going to be recognized within that specific year. That's revenue you have to recognize over X amount of months. It's just money that you received up front. And it's really important to reflect that on your financial statements. Okay, so lastly, let's talk equity, taxes, and the entity of choice. So your cap table, it's a record of who owns what. So your founders, your option holders, your investors, people that have safe agreements. In my opinion, this is very commonly mismanaged, and these kind of errors compound very quickly. So if you have something recorded incorrectly, whether it's like, a safe agreement, or just, even an investor loan, it can really mess up with your financial statements and just make things a lot messier when you're trying to raise funds. I really like using software for managing cap tables as well. So Carta and Pulley are some recommendations I would have on that. Getting more into safe agreements, they're kind of a newer instrument. What it is it's a simple agreement for future equity. Basically, it's money now for equity later, typically at some type of valuation cap, and maybe even at a discount. It's technically not a loan. There's no interest on there. There's no maturity date on there. And the accounting on there depends on basically the terms. So I have clients where we record safe agreements as a liability on their balance sheet, And I have other clients where we record safe agreements as equity under a balance sheet. The IRS does not have any comprehensive guidance on this, and it's not considered taxable when it's received. So it's one of those conversations you really want to have with your CPA, because safes are all different from each other. Like they're not, there's not a copy and paste template for safe agreements. Everyone has different terms depending on their business. So you want to talk to your CPA about it. You want to have them look into FASB, which is kind of where we get our guidance from on how to do specific accounting transactions and how to treat them. Because again, the presentation matters a lot on these, both for you and your investors. So when it comes to your tax filing obligations, at minimum, keep in mind, you're reporting to 3 different authorities on your income taxes. The IRS, that's where you file your Form 1120, that's the corporate tax return. The California Franchise Tax Board, that's where you file your Form 100. That's for the income tax return for California. That's usually where you're going to be paying your minimum $800 tax. And then there is Delaware, where you're filing a franchise tax plus your annual report as well too. There are some nuances on how you file the Delaware annual franchise tax, and missing this can sometimes result in a very scary notice that makes it look like you owe, $80,000 to $100,000 even when you've barely done anything with the business. So let's talk a little bit about how that actually works. Let's assume you just formed your business and you automatically had 10 million shares at the formation of the business. There's 2 methods that Delaware uses to calculate your annual franchise tax. There's the authorized shared method, which is based on how many shares are authorized, right? There's kind of like a scaling number on how much they charge per each share. So like 5,000 or less shares, it's $175 minimum tax. Almost nobody forms a business with 5,000 or less shares. From 5,001 to 10,000 shares, that's basically $250, per share. Then after 10,000 shares, it's $85. So this is kind of one of those situations where, and it's important to understand too, the authorized shares method is the default calculation method for Delaware, especially when you don't file that franchise tax report. So what'll happen is if you don't file it, they'll just calculate that for you. They'll see you have like 10 million shares and they'll say, oh, okay, you owe us at least $80,000 plus interest and penalties and all that. So it turns into almost like a 6-figure bill. And you're sitting there like, dude, my business is literally me, a laptop, and 2 contractors. Like, we're just writing software. How can we owe $80,000 already? That's why you want to make sure you're on top of that and you file it on time. And usually the lowest method of paying that franchise tax, it's through the assumed par value capital method. And that's based off how many shares have actually been issued, not necessarily authorized, plus the total gross assets on your balance sheet. It's basically $400 for like $1 million of assumed par value capital. So you're usually going to end up paying about $400 as a minimum tax when using this strategy. This is probably the better method, especially when you first start up. I do sometimes get asked if a corporation should take a S Corp election for these types of businesses. I usually don't recommend it if you're basically trying to raise funds and get investors into your business. So an S Corp does avoid double taxation and it passes income directly to the owners. And this is really attractive if you're a small business and you're not really looking, to go public or just raise funds in general. There are very rigid rules behind S corporations. So like you can't have more than 100 shareholders. All the shareholders have to be US citizens, and you can only have 1 class of stock. Venture capital funds are usually partnerships or LLCs, so they're not going to be permitted to be shareholders in this. 1 single venture capital investment will terminate the S election automatically. And on top of that too, investors usually require preferred stock. So you can't have 2 different types of classes of stock when it comes to an S corporation. So usually when I'm working like with a solopreneur, or even like a service-based business with maybe, 2 or 3 owners, then I do like S corporations. It's a great tax strategy. But if we're talking about raising capital, you're better off just being a C corporation. I would say I almost never recommend an S corporation for my Delaware, California corporations. So in summary, get things right from the start. The foundation that makes your company financeable is going to be also what keeps you out of trouble. Have clean books, have a well-maintained cap table, use the correct Delaware franchise tax method. Can't emphasize that one enough. Understand how to do proper accounting for safe agreements. I know they're a very common way to get investments nowadays. So understand, whether it should be a liability or equity for your business. Make sure you have your foreign registrations done in California. You should be a C corporation. Like I have a hard time ever recommending an S corporation for these types of businesses. So yeah, it's a lot cheaper to get this right from the beginning versus, going back and trying to fix it later. So yeah, hopefully this was helpful. And yeah, thank you. Please let me know if there's anything that you'd like me to elaborate on a little more. If there's anything I could, explain a little more as well too, you can leave a comment, just message me. Questions are definitely welcome. Thank you.